Speaking of things that have basically gone to nothing, though, we, last July, I think, set up some stock samplers. It was David Gardner from Motley Fool's very last one ever before he retired off of stock picking for them. Still does some interviews and so on, but nowadays leaves the general running of the business to some of the lieutenants from before. But he had a final 5 stock picks for 3 years as of, I think, last July. So we're now approaching the halfway point, very roughly, in our stuff. Steve and I picked 5 of our own as well. We had, I think, one rule, which was that we had to have at least one UK stock each. Oh no, they had to be 5 different ones, obviously. Steve, how's all that going? It's been a pretty miserable year for stocks, and we haven't talked about it very much, especially the ones that we picked. So how are things looking there?
Well, we're all down. If that's any news to you, I would suggest it's probably not. But we are both beating David Gardner. You're beating him by a fair old margin, and I'm beating him by the virtue of being less down than he is. So I'm going to take that as a win. But I think anybody who bought this last stock sampler, and maybe if it was their first introduction to David, would be quite thankful that he's retiring, because he is currently down 49.6% on his 5 stocks. So just to remind you what was in that sampler.
I thought it was going to be worse based on the 2 that I can remember.
Well, he's green on one of them, so which kind of shows you.
I haven't. Is it Axon that he's green on?
It is Axon, yes. So his 5 were Peloton, Trade Desk, Axon Enterprises, Unity Software, and Zillow. So Peloton has taken £2, because that's all we put into each of these. I'm not going to lie to you, we didn't put megabucks in it. But he's managed to turn £2 into 21p. Trade Desk...
It's about 90% then, right?
Yeah, 89.5.
Yeah, sorry.
Trade Desk has taken £2 into £1.39. That's down 30.5%. Axon has taken £2 into £2.18, so up 9%. Unity has taken £2 into 61p, down 69.5%. And Zillow has turned £2 into 65p, so that is down 67.5%. This, we did say, I think, Steve, we're going to let it run for 3 years, because he's going to let it run for 3 years, so there's still plenty of time left in this sampler. But if you were comparing it to the S&P, which is what it usually compares all of these things to, it's going to be a big loser. Any thoughts?
Yeah, my takeaways on the Gardner sampler are twofold. One is that, and I know this is always easy to be wise after the event, and maybe we're always kind of slightly influenced by stock price movements, and we sort of let the market tell us what to do a little bit rather than keeping our own thoughts here. But when I look at those and the returns on them, and they're nearly all kind of down, but the one that's up as well, they are pretty much in rank order of the order that I'd like to add them to my own portfolio in. So I would most like Axon. I would least like Peloton. Above Peloton, probably Zillow. And those other 2 kind of in either order, but I probably prefer the Trade Desk to Unity. So I'm a little bit more indifferent towards that middle bit. But I sort of think that makes sense to me, and I'm trying not to just be led by the thought of, well, clearly this is a good stock because it's done well for the last 18 months or so. And my thought, though, is that that's pretty much what I would have expected in terms of rank order, not necessarily in terms of them all going down.
Well, I think Axon deserves probably a little bit of credit, really, because it's been a winner in a period of time when that sort of stock that trades on that sort of multiple has been crushed. So fair play to Axon for continuing to produce results for him. I mean, Peloton, Zillow, and Unity have all been very, very bad performers, and Trade Desk has kind of just been caught in a macro withdrawal from the advertising market, which is obviously going to affect Trade Desk. But I'll move on to the second position, which is myself. My stocks, or my 5, are down 38.3%. And just to remind you of the 5, I'll go through them one by one like I did before. So I've managed to turn, with Alphabet, £2 into £1.65. That's 17.5% down. £2 into £1.64 on Sartorius. That's 18% down. £2 into £1.50 on Autodesk. That's 25% down. £2 into 81p on Tremor International, that's 59.5% down. And surprisingly, in last place, the value stock that I put in there, was Scott's Miracle Grow, and that's £2 into 57p. That's actually down 71.5%. I thought out of all of them, Scott's was the one that was least likely to do anything, and it's done the most, least, worst, the worst, whatever the saying is. It's done shit.
It's underperformed your underperformers in general. So Google has been your best of them, basically. Then,
yeah, Google and Sartorius are a penny away from each other in terms of it. So yeah,
they're basically adjacent. Scott's Miracle Grow is the one that I always remember that you have, but always forget to pay any attention to what it's doing. I agree with you. It's the one that I thought you have a bunch of other sort of similar-ish stuff going on there, and I thought, look, if markets go down, that one might just do enough to keep you in the hunt here and do kind of well, but it's actually leading the charge downwards for you. There was a time a few months ago, and this does go to show you this stuff can all turn around very, very quickly, where I thought Scott's Miracle Grow was up for you at one point, and it was pretty much the only thing that was, as this was around the days when people were starting to get a bit wise to Peloton and so on the Gardner portfolio. But any ideas what's happened there?
I was just trying to have a quick look now while we're on the phone. It looks like they've just had really rapidly declining sales, and in the last 2 quarters they've changed from decent net income to losing money. So, in fact, there's been quite a rapid decline in their sales. Look at them now, year-on-year changes down about 33%. So, this company has collapsed. Apparently, it's still paying a 5.37% dividend, which worries me quite a bit, really, because there's
with what?
There's no cash flow to be paying dividends. So, apparently, it was founded in 1868. I totally missed that. Were we doing fertilizer in 1868?
We weren't doing anything else, were we? That was tech back then.
Yeah, true.
Okay, how am I doing, Steve?
So you, Steve, are winning quite comfortably. You have turned the £10 original investment into £9.51. Which is, you've got your little funky bit where
Black
one of
trading
Steve's
stocks for the win.
Yeah, one of Steve's companies was kind of bought and span off a little sort of arm of it, so it kind of throws the numbers out a little bit. But overall, the Aspen technology is flat, essentially, from my maths. So you're essentially £2 into £2 there at the moment. Your other stocks, though, Alibaba, you have turned £2 into 86p. That's down 57%. You have Renishaw, which has changed £2 into £1.46, down 26.63%. You have Roblox, which has managed to change £2 into 70p. That's down 65%. But your winner, and the one that is making you far and above me and David Gardner, is your PG&E has changed £2 into £3.61. Unbelievably up 80.5% on a stock that I bet you didn't expect would move that much.
I'm not sure what I expected from that, to be honest with you. Here was the story around PG&E. They'd basically been going through something approaching bankruptcy proceedings, and they were roughly getting ready to exit those. So they were in a lot of trouble back when we started this sampler as a result of causing a bunch of fairly horrific forest fires over in California that had resulted in several deaths. And I'm not saying that lightly by any means. They were justifiably on the hook for quite a lot in the way of Widows and Orphans Fund, basically. And one thing the market doesn't like is uncertainty. It doesn't like people losing money and causing deaths either. But what it really doesn't like in this context is uncertainty as to how all that's going to kind of play out. You've seen it a little bit recently with Glaxo shares while they were dealing with a legal case around cancer-causing things. But that's kind of all finished and is working its way through. And they, I think, have a roughly agreed 9.5% maybe with California return on equity, and one feature of having a lot to do with kind of starting forest fires is they need to invest quite a lot, and they're going to get a good return on that. So I knew when I was buying that, I was buying it around the bankruptcy time. It's a utilities stock. It wasn't likely to completely go out of business. Was I expecting it to go up 80-something%? Absolutely not. If we'd had a big bull market, I was thinking it was the one that might have cost me, to be honest with you, because I thought it might well just chug along a little bit and maybe move 10. It's done a lot better than I thought it was going to as people try and seek out any kind of growth across this sort of market. Apart from that, I think my general takeaway from two of mine is that I didn't ought to. It's okay for a bit of fun on a stock sampler with a couple of quid, right? But in general, buying stuff that you don't understand very well or know about very well is a bad idea. So the two that stand out here are Renishaw and Roblox, where my investing theses were very, very thin in these. Both of these, I don't know them that well. Renishaw I know to be a kind of manufacturer from the FTSE 250. Cathy Wood had it in her 3D printing ETF at one point. I had to come up with the UK stock. That was the best I could think of at the time. Didn't really want it very much, but it's proved to be pretty poor. I always forget I have Alibaba. I'm surprised that's not down by more. I think I might have just caught this on a lucky sort of update when you were updating this.
Yeah, it's had a big uptick. There's quite a lot of the Chinese stocks have had a sort of a recent uptick. With that pie we were looking at earlier, Steve, it was very interestingly spread out. Alibaba has made a pretty decent comeback, really, is how I would explain it. I mean, we're not talking about it heading back to the sort of, I think it was $400 at one point, wasn't it, off the top of my head, or at least in the sort of late 300s. But
well, when I sold it the first time, and I have owned it since then and sold it since then, I sold it at 273, and the last time I looked at it was about 80 or so.
Yeah, I think it's back nearer $100 at the moment as well, so that is perhaps... But you would, even still... even if you caught us on those down days, you would still be outperforming us. In terms of my portfolio, I've got a couple of advertisers in there. I've got Tremor International, which is an Israeli company that trades on the London AIM, handles the scatter market for TV advertising. Scatter market is dead at the moment. There's not that secondary budget that Steve and I spoke about a number of times in advertising. That secondary budget has dried up to almost nothing. Alphabet will be a net benefit of advertising primary budget, but will not benefit from scatter budget. So they're also getting hit. And then I've got Sartorius, which was an expensive stock, is just reverting back to a less high PE. I guess it's trading to a more realistic valuation.
Do you think there's a sort of line that we could use to try and work out where it might go next?
They don't have European stocks, so I don't know.
They not have the line? I have to plot it myself based on their PE and stuff.
Yeah, Autodesk is just slowing a little bit, I guess. They've given some pretty weak guidance, but up until that point, we're held up quite well. And then obviously we've talked at length about Scott's Miracle-Gro. That's just not doing the business.
No, Roblox in my case, you called that a fad at the time, I think, and it's certainly the case that the momentum hasn't come through in the way that people with more money in it than either of us might have hoped for from a kind of metaverse perspective.
Still, with Roblox, if that price, I mean, I know we're talking about stock that's already down a lot, but if that stock got another sort of 30% off it, 35% off it, I'd be quite interested in that around the sort of 10 to 12 sort of billion kind of mark. I think there's still a lot of legs in that. Both my nieces play it to absolute death. They've got all their friends on it as well. It's kind of like become the stepping ground from Minecraft, which is what they originally started playing. They now all play Roblox, and it's quite a social thing. They all go on and play together and build things, and even go to concerts and Nike stores and things like that in Roblox. So it's all kind of strange. I think they could end up with a better metaverse than Zuck, which would be like the ultimate irony if you've seen how much money he's poured into it.
They are the only metaverse thing I've heard of that's not called Meta Platforms, I think. But I only thought of this, and I thought of the things today because I was in WH Smith's looking for Christmas presents and cards and so on, and I saw like Roblox gift vouchers and thought to myself, oh yeah, that's still a thing, I remember that. And then thought, hang on, I own that in my sampler thing, we should check how that's going. I imagine quite badly, and I'm sort of pretty much correct. It's down about 2/3 or so from where it was when I decided it was worth having in my stuff. Maybe we'll do this again sometime in a year and a half when we kind of run out of them. Include Paul in that game, that'll be fun.
Yeah, absolutely. I think we should do it again, just because it's fun.
Yeah, I'm enjoying it. But I guess we might, again, spoilering it ahead, have some stock picks for 2023 when the time comes, and I suppose we can see how they go. Paul will definitely have some.